In this worksheet, we're going to calculate the financial break-even bid price for a 5-year project. Recall, financial break-even is where our net present value of a project equals 0. Let's go ahead and begin with the following assumptions, and we're going to assume to start with our bid price is $14. We find it much easier to build a worksheet with a given bid price rather than leaving that field blank. So let's go ahead and start. Time 0. Our units that we sell, 150,000 units. We want an absolute cell reference because it's always going to be coming back to that same cell. Our bid price, $14. Again, an absolute cell reference. And our revenue then will simply be relative cell reference, 150 times our $14 bid price, or $2.1 million. Our variable production cost, we could link it to our units up in cell B4 with an absolute cell reference, or we can link it to the units in cell C13 with a relative cell reference, and again multiplying it by our variable cost per unit of 850. And again, that one has to be an absolute cell reference. Our fixed production cost is $240,000 per year, absolute cell reference. Our depreciation expense for tax purposes is simply our cost divided by our estimated project life, which in this case is 5 years. We ignore salvage value for calculating depreciation expense for tax purposes. So we've got our 780 absolute cell reference divided by 5 years, again absolute cell reference, and hit enter. Our taxable income then will be our revenues of $2.1 million minus our variable production cost, minus our fixed production cost, minus our depreciation expense. Our taxes then will be our taxable income of $429,000 multiplied by our 35% tax rate, again absolute cell reference, and our net income will be our $429 minus the $150,000 in taxes, or $278,850. To calculate our operating cash flows, we take net income and add back depreciation expense, so let's link to our depreciation expense, and then finally calculate our operating cash flow as net income of $278,850 plus our $156 in depreciation expense. We have an annual operating cash flow of $434,850, and we can copy that across to all 5 years since we're assuming that there's no changes in the units sold or in our selling prices or cost over this 5-year project's life. Let's go ahead and calculate our terminal cash flows. We're estimating a salvage value of $50,000. Now, since we've fully depreciated our equipment, we could take a little bit of a shortcut and calculate our taxable gain as simply our selling price minus 0, our net book value, multiplying that by our tax rate. But rather than do that, let's go ahead and put in a formula for our net book value in case we were wanting to change the estimated life of our equipment. So let's go ahead, equals our selling price of $50,000 minus our net book value. That's going to be our project's initial cost of $780 minus the sum of any depreciation we've taken. And the depreciation we've taken is right here in row 19, cells C19 through G19, close parenthesis. All right, so now we've calculated our taxable gain, and we simply need to take that entire amount and multiply it by our tax rate of 35%. Now notice, we had a taxable gain of $50,000 if we had a 5-year equipment life. But if our equipment life had been 7 years, we would have actually had a taxable loss at the time of the sale, and we would have had a cash tax savings. So there's our taxes. We had a gain. Oh, since we have a gain, we need to make sure we put what? A negative sign in front of this, as it's going to be a cash outflow. Working capital. We have a cash working capital outflow of $75,000 at time 0, and we will recover our working capital at the end of the project. Equipment. We had a cash outflow of $780,000 at time 0. Let's go ahead and calculate our annual cash flows. Equals sum, and we're simply going to add up rows 26 through 31, and we can copy that across. Notice by adding cells 26 through 31, we had a formula that we could copy completely across, even though there weren't any cash flows at time 0 in rows 26. Next, we need to calculate the present value. That's simply equal to the future value divided by the quantity 1 plus R, our interest rate, our required rate of return of 16%. Anchor that because we're going to keep coming back there to the, in this case, 0 power for the time 0 cash flow, and we can hit enter. We can copy that formula across, and then to calculate the net present value, we can simply sum all of those cash flows. And we get a net present value of $620,000.09 with a $14 bid price. Before we go ahead and calculate our break even, let's go ahead and calculate our IRR equals IRR. And again, we simply highlight the cash flows, time 0 through time 5. And we get 43.4%. Recall, one of the problems with our IRR calculation is it assumes that all of our cash flows are reinvested at this internal rate of return, which can sometimes be somewhat unrealistic. So instead, we can also calculate, recall from finance, our modified IRR. We won't talk about what it is, but we'll go ahead and calculate that using Excel. Equals MIRR, parenthesis, and let's go ahead and hit the FX field to pop up our fields. First, we're going to pick up our values. Our values are simply our annual cash flows. Our finance rate, that's going to be our required rate of return of 16%. And in this case, we could pick the same reinvestment rate, or we could pick an alternative reinvestment rate, lower or higher. Let's go with the same 16% and hit OK. And we see our project has a modified IRR of 29%. Now to calculate our financial break-even, that was where our net present value was equal to 0. We're going to find our minimum bid price. So again, we're going to use our goal seek function. So click on data, what if, and we want goal seek, and we wanted to set cell 36, that's our net present value, to 0 by changing our bid price. And we find a bid price of $12.05 indeed gives us our net present value of 0. And notice at that rate, our modified IRR equals our internal rate of return.